7 days. That is the amount of time standing between a tense trade negotiation and a potentially dramatic new tariff shock. Washington and Ottawa are once again locked in negotiations, and the clock is becoming one of the most important factors in the entire dispute. The Trump administration has threatened a 50% tariff on certain Canadian products, with the latest deadline creating enormous pressure on both sides to reach an agreement before the new measures take effect. But here's the part that matters most. Trade officials aren't simply sitting back and waiting for the deadline. They are rushing to negotiate. They are looking for exemptions. They are trying to protect critical industries. And they are attempting to find a deal that both governments can sell politically. Because behind the headlines about tariffs is a much bigger question. How much economic damage are the United States and Canada willing to accept before they compromise? And could the next 7 days determine the direction of North American trade for years to come? Let's start with the basic situation. The United States and Canada have one of the most integrated economic relationships in the world. Goods cross the border every day. Energy flows south. Electricity moves across the border. Cars and auto parts travel between factories. Agricultural products move in both directions. Minerals, lumber, machinery, and industrial components are constantly moving through the North American supply chain. This means a major tariff increase doesn't simply affect Canadian companies. It can also hit American businesses that depend on Canadian inputs. That is why the 50% figure has attracted so much attention. A tariff of that size could fundamentally change the economics of certain cross-border transactions, and companies have very little time to prepare. Now, there is an important distinction that viewers need to understand. A headline saying 50% tariff on Canada does not necessarily mean every Canadian product suddenly becomes 50% more expensive for American consumers. Tariffs can apply to specific categories. There can be exemptions. There can be special agreements. There can be rules under existing trade arrangements. And the final implementation can be very different from the initial threat. That's why these negotiations matter. The next 7 days aren't just about whether a tariff exists. They're about which products are covered, which industries receive exemptions, how the tariff is calculated, and whether the two governments can reach a broader agreement. And this is where the White House becomes the center of attention. When trade officials rush into high-level negotiations, markets immediately start asking the same question. Is a deal coming? Maybe. But negotiations can also fail. And that uncertainty is precisely what businesses hate. Imagine you're running an American manufacturing company. You purchase a major component from Canada. Your supplier has a long-term contract with you. Your factory is built around that supply chain. Suddenly, you're told that a 50% tariff could apply. What do? You could ask your Canadian supplier to lower its price. You could try to find an American supplier. You could search for a Mexican supplier. You could import from another country. Or you could simply pay the tariff and pass some of the cost to your customers. But none of these options is easy. Finding a new supplier can take months or years. Rebuilding a factory is extremely expensive. Changing production lines requires capital, and some Canadian products simply don't have easy substitutes. This is especially important in energy. Canada is one of the largest sources of crude oil for the United States. American refineries have been designed over many years to process specific grades of crude. So even if another country has oil available, that doesn't automatically mean it can replace Canadian supply at the same cost. The same principle applies to electricity. Canada supplies electricity to multiple U.S. states. A tariff on energy can therefore have consequences that reach far beyond the original target. It can affect utilities, it can affect manufacturers, it can affect transportation, and eventually it can affect consumers. This is why both governments have an incentive to keep negotiating. Neither side wants a major economic disruption if it can avoid one. But politics makes compromise much harder. President Trump has built much of his economic strategy around tariffs. Tariffs are presented as a tool for forcing trading partners to make concessions. The argument is straightforward. If access to the American market is valuable enough, other countries will eventually agree to Washington's demands. Canada, however, has its own political constraints. Canadian leaders cannot simply accept every American demand without demonstrating that they are defending Canadian economic interests. That creates a classic negotiation problem. Both sides need a deal, but neither side wants to look like it surrendered. And that is why the final hours of negotiations can become extremely unpredictable. Let's talk about the economic stakes. The United States and Canada conduct hundreds of billions of dollars in trade every year. The relationship is deeply integrated. According to the U.S. Trade Representative, U.S. goods trade with Canada totaled roughly $719.5 billion in 2025, USTR.gov. That is an enormous economic relationship. And because so much of it involves intermediate goods and supply chains, the value of trade isn't the only thing that matters. The structure matters. If Canada sells a component to an American factory, and that factory uses the component to produce a finished product, the tariff can affect both sides of the transaction. That's the difference between a simple import and a deeply integrated supply chain. And it explains why businesses have been watching these negotiations so closely. Now imagine the deadline arrives without an agreement. The tariff takes effect. What happens next? First, importers begin calculating the immediate cost. Some will absorb it, some will pass it on, some will renegotiate contracts, some will search for alternatives, and some may reduce imports entirely. Then Canadian exporters respond. They may lower prices, they may seek other customers, they may ask Ottawa for support, and the Canadian government could respond with retaliatory measures. This is where a bilateral tariff dispute can turn into a much larger trade conflict. Retaliation creates another layer of costs. If Canada places tariffs on American agricultural products, American farmers can be affected. If Canada targets industrial products, American manufacturers can feel the pressure. And if the two governments keep escalating, businesses begin planning around a longer-term trade war. That is when the damage becomes more serious. Because uncertainty starts changing investment decisions. A company that planned to build a factory in Canada may delay the project. An American company may decide to build a duplicate factory in the United States. A Canadian manufacturer may decide to target European or Asian customers instead. A logistics company may invest in new routes. And suddenly, a temporary tariff begins producing permanent economic changes. This is one of the most important things to understand about trade wars. The immediate tariff is not always the biggest cost. The biggest cost can come from the decisions companies make because they don't trust the trade environment anymore. And Canada is already thinking about diversification. Ottawa has been pushing to expand trade beyond the United States. That doesn't mean Canada can replace the American market overnight. It cannot. The United States is simply too large and too close. But Canada doesn't need to replace America entirely. It only needs to reduce its dependence. Suppose a Canadian company previously sold almost everything to American customers. Now it begins developing markets in Europe and Asia. Those new customers may represent only a small percentage at first, but after 5 or 10 years, that percentage can become significant. And once those relationships exist, Canadian businesses have more bargaining power. That creates a long-term strategic problem for Washington. The more the United States uses tariffs to pressure Canada, the more incentive Canada has to build alternatives. And once those alternatives are built, they don't disappear simply because tariffs are removed. That's why this 7-day countdown matters. The decision made before the deadline could influence whether North American companies continue investing in integrated supply chains or begin building more independent ones. Now let's look at the Canadian side. Canada has several advantages in this negotiation. First, geography. The US-Canada border is the world's longest international land border. Second, resources. Canada has enormous supplies of energy and raw materials. Third, infrastructure. The two economies are connected by pipelines, railways, highways, power grids, and industrial networks. Fourth, Canada has alternative markets. Europe and Asia cannot immediately replace the US, but they can provide diversification. And fifth, Canada can retaliate. That doesn't mean retaliation would be painless. It could hurt Canadian consumers too. But the ability to impose countermeasures gives Ottawa leverage. Now consider the American position. The United States has the larger economy. It has the world's largest consumer market. American companies have enormous purchasing power, and Canada remains heavily dependent on US demand. That gives Washington significant leverage. But leverage is not the same thing as unlimited power. If you push a partner too hard, the partner may begin looking for ways to reduce dependence. And that's exactly what markets are watching. Will Canada compromise? Or will Canada accelerate diversification? Will American businesses continue relying on Canadian suppliers? Or will they begin moving production elsewhere? The answers may not become clear in 7 days, but the decisions made during these 7 days could influence the direction of those trends. Now let's talk about consumers. The average person doesn't wake up thinking about tariff schedules. They think about the price of gasoline, the price of groceries, the cost of a car, the cost of electricity, the cost of home repairs, and the cost of everyday products. So the key question is, could a 50% tariff actually affect consumers? Potentially, yes. But the impact depends heavily on which products are covered and how companies respond. If a tariff applies to a product that has many alternative suppliers, companies may switch sources. If there are few alternatives, the tariff can be harder to avoid. If the product is an important industrial input, the cost can spread through multiple stages of production. And if businesses pass the cost to consumers, retail prices can rise. This is why tariff policy can create a difficult situation for the Federal Reserve. If tariffs push prices higher while also reducing economic growth, policymakers can face a classic dilemma. Inflation goes up, growth slows, and the central bank has to decide how aggressively to respond. That's one reason financial markets can react sharply to major tariff announcements. Investors aren't only thinking about trade, they're thinking about inflation, interest rates, corporate earnings, consumer spending, and economic growth. A major tariff escalation can therefore affect stocks, bonds, currencies, and commodities. Now let's turn back to the White House. What exactly could a last-minute deal look like? There are several possibilities. The first is a broad agreement. The two sides negotiate a package that reduces tariffs and creates a new framework for trade. The second is a partial agreement. Some products receive exemptions while other tariffs remain. The third is a temporary extension. The deadline is pushed back to give negotiators more time. The fourth is escalation. The negotiations fail and the tariffs take effect. And the fifth is something in between. The governments announce progress while continuing negotiations on the most difficult issues. From an economic perspective, even a temporary extension could matter. Businesses would get more time, markets would get more certainty, and companies could avoid making emergency supply chain decisions. But it would not solve the underlying dispute. That's why investors need to distinguish between a delay and a real agreement. Now, there is another factor that could shape the outcome: energy. Canada's energy exports are strategically important to the United States. And American demand for Canadian energy is not easy to replace immediately. This creates a unique negotiating dynamic. Washington can threaten tariffs, but American companies still need the resources, and Canada can threaten retaliation, but Canadian producers still need access to the enormous American market. This is mutual dependence, and mutual dependence can either create stability or create conflict. It depends on how the governments use it. If both sides recognize the costs of escalation, they have an incentive to compromise. If both sides believe they can force the other to surrender, the risk of escalation increases. That is why political messaging matters so much during these final days. A leader can make compromise more difficult by publicly declaring that only one outcome is acceptable. And trade officials can sometimes have more flexibility behind closed doors than politicians have in public. That's why the phrase secret deal can be misleading. Most major trade agreements aren't literally secret, but negotiations often involve proposals that aren't publicly announced until both sides are confident enough to present them. A proposal can move through multiple versions. A tariff can be reduced, an exemption can be added, a quota can be negotiated, a sector can be carved out, and a broader commitment can be attached to the package. That is what makes the final week so unpredictable. Now let's think about the bigger geopolitical picture. The United States and Canada are not only trade partners, they are military allies. They cooperate on energy security, they cooperate on border security, they cooperate on defense, they share intelligence, and they are both part of the broader North American economic system. A prolonged trade war could therefore have consequences beyond economics. If trust between Washington and Ottawa deteriorates, cooperation in other areas can become more complicated. And that is another reason both sides have an incentive to prevent the dispute from spiraling. But the damage to trust can happen even if the tariffs eventually disappear. Businesses remember uncertainty, governments remember threats, and investors remember periods when trade rules change suddenly. That memory can influence future decisions. This is why the current dispute isn't just about the next 7 days. It's about the next 10 years. Will North America remain a highly integrated manufacturing and energy system? Or will companies gradually build parallel supply chains? Will Canada remain overwhelmingly dependent on American customers? Or will Ottawa successfully diversify? Will the United States continue treating tariffs as its primary negotiating tool? Or will Washington eventually decide that stable trade with its closest neighbor is more valuable? Those are the questions underneath the headlines. And there is one particularly important number to watch: the share of Canadian exports going to the United States. If that percentage remains extremely high over the next several years, it will suggest that geography and economic integration remain stronger than political tensions. If it begins falling significantly, it would indicate that the relationship is structurally changing. The same is true for American imports from Canada. If companies begin replacing Canadian inputs at scale, that could indicate a major supply chain shift. But replacing supply chains is expensive. So the process would likely be gradual. That's why the next 7 days should not be viewed as a single dramatic moment. They are the latest chapter in a much larger negotiation over the future of North American commerce. Now imagine the worst case scenario. The deadline arrives. No agreement. The 50% tariff takes effect on targeted products. Canada retaliates. The United States responds. Businesses face rising costs. Markets become nervous. Companies begin delaying investment. Consumers see higher prices in affected categories. And the governments become increasingly unwilling to compromise because each side has already invested political capital in the conflict. That is how trade disputes can spiral. Now imagine the opposite. The two sides reach a last-minute deal. Tariffs are reduced or exempted. Critical sectors are protected. Businesses get clarity. Investment continues. And both governments claim victory. That is certainly possible. In fact, the economic incentives strongly favor some form of compromise. But politics can produce outcomes that pure economics would not predict. And that's why these negotiations are worth watching minute by minute. So what should you remember as the deadline approaches? First, don't focus only on the headline tariff percentage. Look at the products covered. Second, don't assume the tariff will be paid entirely by Canada. American importers can bear some of the cost. Consumers can bear some. Companies can absorb some. And suppliers can absorb some. Third, watch retaliation. A tariff announcement from Washington is only the beginning if Ottawa responds. Fourth, watch energy. Energy flows could be one of the most important indicators of how much real economic disruption is occurring. Fifth, watch the language coming from both governments. If officials start talking about exemptions, quotas, and sector-specific agreements, that could signal progress. If the language becomes increasingly aggressive, the risk of escalation may be rising. And finally, watch the businesses. Companies often reveal the real economic consequences before government statistics do. If manufacturers begin warning about supply disruptions, that's important. If retailers start raising prices, that's important. If companies announce new factories outside Canada, that's important. And if companies continue investing heavily across the border despite the political tensions, that tells us the underlying economic relationship remains extremely strong. Now let's return to the central question. Has Trump pushed Canada too far? It is too early to know. But there is a clear strategic risk. The United States can use its massive consumer market as leverage, but Canada can respond by reducing its dependence. The United States can impose tariffs. Canada can retaliate. The United States can threaten more pressure. Canada can seek alternative customers. And eventually, both sides could discover that the relationship they once took for granted has become more expensive and less predictable. That would be the real trade shock. Not simply a 50% tariff, but a structural shift in how North America does business. For decades, companies optimized supply chains around efficiency. Now they are increasingly optimizing around resilience. And the Canada-US dispute could accelerate that transition. The next 7 days are therefore much bigger than one deadline. They are a test. Can Washington and Ottawa preserve one of the world's most important economic partnerships? Or will political pressure push both countries toward a more fragmented trading system? The answer could affect everything from factory investment to energy prices, from inflation to interest rates, and from corporate profits to household budgets. And remember, even if a deal is announced at the last minute, the story isn't over. The real test will be whether the agreement creates enough certainty for businesses to invest again. Because companies don't build billion-dollar factories based on temporary political promises. They build them when they believe the rules will remain stable. That is what both governments need to understand. A tariff can be announced in a press conference. A supply chain can take years to build. And once a company moves production, it may never come back. So as the 7-day countdown continues, the world is watching Washington and Ottawa. The question isn't simply whether a 50% tariff will happen. The bigger question is whether the United States and Canada can prevent a temporary political dispute from becoming a permanent economic separation. Because if they fail, both countries may discover that the most expensive tariff isn't the one collected at the border. It's the tariff that convinces businesses to stop building their future around the relationship. And that is why these next 7 days matter. The clock is ticking, the negotiators are moving, businesses are waiting, markets are watching. And somewhere between Washington and Ottawa, the future of North American trade is being negotiated right now.